Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, the news and analysis you need to know for the week ahead in Bitcoin. Today is Monday, January 25th, and we have a lot to cover today, starting with a lot of earnings coming out of the U.S. equity markets. We have a large amount of companies reporting, including 13 out of the 30 companies in the Dow Jones Industrial Index. We also have the first Fed meeting of the year, the first one under President Joe Biden, and with the Fed being the voice of comfort for a lot of investors recently, a lot of market participants are going to be looking in closely, and so will we. We're also going to talk about the anatomy of a squeeze. Last week gave us a great opportunity to look at a long squeeze in the FTX DeFi index, and we're also going to look at a short squeeze of epic proportions that is currently happening in the shares of GameStop in the US equity markets. So, lots to cover today. Onwards to our analysis. So, starting as we usually do with Bitcoin, we see that last week, Bitcoin had its second straight week of losses amid very, very high volatility in the markets. Bitcoin finished the week at $32,288, down 9.86%. Now, during the week, we also saw the GBTC premium get compressed to 2.7%, as we can see here in this chart. This is very meaningful. We see that the prior time that it had been around this level was around March of last year, of actually 2020, which it went down actually to 3.03%. Now, this is quite important and meaningful for the Bitcoin industry or the Bitcoin markets, and we will be discussing what this means in more length in our What's Ahead section today. Over the course of the week, another important news that we saw was also Microstrategies. Michael Saylor announced that his company had bought the dip yet again and had purchased an additional $10 million of Bitcoin at an average price of $31,808. And while this is a small purchase in comparison to their existing position, Saylor also sees potential benefit in signaling to the market that there is still institutional appetite for Bitcoin in the low 30,000s levels. Last but certainly not least, we saw that BlackRock, the largest asset manager in the world, said that it would start allowing two of its funds to get exposure through Bitcoin through the Bitcoin futures markets. Now, the move allegedly comes as a response to increased investor demand. And as the headline by the Times reads, which you can see behind your screen right now, BlackRock giving Bitcoin its seal of approval can be considered, or is likely to be considered, a massive signal in the institutional investor community for Bitcoin. Now, going back to the charts, we continue to see mixed signals in the crypto markets in a very resilient ball of hot money that does not seem to go away. The price action that we're seeing in DeFi versus Bitcoin, and just to exemplify that in a second, here we see that last week Bitcoin was down 9.86%. If we move over to the DeFi index, we see that it not only was up 13.93%, but it actually rocketed to a new all-time high. So this price action continues to illustrate, as we have been discussing here before, that there's very likely still a large presence of short-term speculators, and what could be interpreted from these charts is that some of these short-term speculators are becoming frustrated that Bitcoin is not going up fast enough, or that Bitcoin is too expensive, and they're getting drawn to faster-moving coins. And so these faster moving coins oftentimes have the promises of being the next Bitcoin or the next Ethereum. We have seen this market dynamic before. This DeFi could very well become this Bitcoin's rallies ICOs, which was a phenomenon that we saw in the last Bitcoin rally. And in the past, we've seen these types of trends wane away as regulation eventually catches up and the sheer volume of new projects causes investor fatigue, and the hype slowly wanes until it reaches a tipping point. Now, we had some very interesting developments in the regulatory front last week, which affected DeFi. We're going to be talking about that in the DeFi section, as well as a few other things for Bitcoin. And we're also going to be talking about what the options markets are showing for Bitcoin for this January 29th expiration. We'll be covering that in our What's Ahead section later today. Moving over to the S&P 500, we see that the new president-elect drove the S&P to a brand new all-time high last week, with the S&P closing up 3,841 points last week, up 1.94% for the week. As we can see here, this is last week's candle. As we've written about in the last issue, the banks kicked off the earnings season last week, and they did so with a bang. Let's take a look at some of the headlines. From what we can see here, it is evident that Goldman Sachs essentially crushed analyst estimates. So did JP Morgan, posting blowout numbers with stronger than expected trading figures. Now, let's take a quick look at the headline that came out of the report from Bank of America. In here, what we start seeing is that even though it did exceed analyst expectations, revenues fell short. And if you read in more detail these reports, what is evident from these reports is that the revenues and profits that the banks are posting did not come from their retail banking divisions, but from their trading arms. Now, this exemplifies that the areas of growth and revenue over the course of 2020 for banks were not their lending portfolios or their day-to-day banking activities. It was their trading, essentially. And this happened as investors were frantically shuffling between financial instruments to try to position themselves for growth and to hedge their risk. Now, with analysts predicting that the 2021 will be one of the best trading years for the United States since the Great Recession, that's a big claim, but it was actually mentioned in a couple of articles over the weekend. And there's also a lot of talk about a slew of IPOs in the pipeline for this coming year. So investment banks look to have a pretty phenomenal year ahead. With all the stimulus activity and incentives that we're also expected to see throughout the year, retail banks are also likely to potentially benefit in that environment. Now, having said all this, the coming week is packed with earnings and, very importantly, the Federal Reserve's first official meeting of the year and the first one under President Joe Biden. The market will be looking very closely to what the Fed has to say, as the yields in the 10-year Treasury have moved over 1%. Now, while that 1% number is not in itself that impressive, we're going to look at what this means essentially and why this number is so important. What you're seeing behind your screen right now is essentially the 10-year Treasury yield. One second, I'm just going to refresh this here. What you're seeing in your screen right now is the yield on the 10-year Treasury. And as you can see here, it has essentially, it came down last year and it's remained below 1%, but it's pretty clearly broken its downtrend and it's starting to move higher. What does this mean? It means that investors are starting to demand higher interest from these treasury bonds because of inflation expectations in the future. Now, what seems to be happening here is that investors are picking up some of their inflation expectations, and you may start seeing pressure within some voices of the Federal Reserve to essentially start discussing a potential of increasing rates. It will be very interesting to see how Powell, the chairman of the Fed, manages this or navigates through this, because he has been very vocal about them not wanting to front run or potentially spoil any type of inflation creeping into the economy by moving too fast. So, like we said, the market will be watching very closely, and so will we. Now, let's move over to gold. So as we can see from the chart below, the last week was a positive week for gold, having gold close at $1,854 per ounce, or up 1.49%. Now, looking at the price action in equities and the bond markets, gold is potentially catching a bid because of the increased sign of inflation expectations in the markets. So something to keep our eyes on as the Fed meets this week. Moving over to DeFi, as we briefly mentioned earlier, we see that it had a blowout week last week. And the biggest catalyst for this sector as a whole was likely the news that the Biden administration was going to be freezing the proposed FinCEN legislation around KYC and self-hosted wallets. This law that is essentially being talked about in the one mentioned in the article, as contemplated, would have signified a very significant blow to DeFi, because it would have likely required all service operators to properly KYC their clients, something that the majority of DeFi platforms don't do. Now, this led to a lot of volatility in the DeFi index. As you can see here, the index was actually down close to 23% in the week before, basically not only recovering, but moving over to a new all-time high. Now, the last 3 weeks, as we can see, have given us shakeouts, elevation higher, shakeouts, elevation higher, shakeouts, elevations higher, into a new all-time high that has effectively doubled the index since its all-time highs. We were up to highs of the mid 6,000s, and the previous high was around the low 3,000s. So doubling in 3 weeks through a lot of volatility. This has the potential of continue happening until basically retail money runs out or goes away. As we will be discussing below, high volatility is very, very common when markets start getting crowded with short positions and extreme leverage positions, particularly when their underlying assets are so thinly traded as they are in DeFi. Given the price action that we're seeing and the index defying gravity into new all-time highs, the potential for more volatility remains very high. And in the very next section, we're going to be discussing what is a squeeze, the anatomy of a squeeze. We're going to be talking about both long squeezes and short squeezes, and we're actually going to be using last week's DeFi move as an example. So onwards to our squeeze analysis. So in today's market trends section, we're going to talk about what is a squeeze, both a long squeeze and a short squeeze. So to start, let's talk about what is a squeeze. So you can think of a squeeze as a situation in which an investor has borrowed an asset to carry out a financial transaction and is forced to close his or her position to return the borrowed assets. The most common reasons that investors borrow assets in a market are to go long or to go short. In summary, when an investor is going long, they typically use the assets they already have in their portfolio to secure or borrow for more cash to purchase more assets for the portfolio. In this case, the investor believes that the cost of borrowing the assets will be lower than the price appreciation of the assets purchased. And the investor stands essentially to make an outsized profit if the value of the assets in their portfolio go up. However, if and when the value of the assets in the portfolio approach the value of the cash that the investor has borrowed, then the lender of that cash must sell the investor's assets to recuperate the cash that it lent. So from an investor standpoint, the more cash you borrow, the higher the risk and the higher the potential payout. Now, let's talk briefly about what a short position is. When investors borrow assets to go short, they typically put up cash as collateral to borrow an underlying asset that they believe is overpriced or overvalued. They will then sell the borrowed asset with the expectation that they can repurchase the asset or the same asset at a lower price in the future and return the borrowed asset. In this case, the investor believes that the profits from selling the asset and buying it back will be cheaper than the total cost of borrowing that asset. Now, there's an added risk to a short position that is not necessarily present in a long position, which is that the price of a stock can theoretically rise into infinity, which means that there's technically no limit into how much an investor can lose if the stock that they borrow to sell increases in price. Now, the best way to understand these market phenomena is to look at how they play out in the wild and analyze the reasons why. So today, we're going to look at the long squeeze that occurred in the FTX index over the weekend, and we're going to look at a short squeeze of epic proportions that is happening right now in the shares of GameStop in the US equity markets. So first, let's take a look at the long squeeze as illustrated in the DeFi index this last week. All right, so let's take a look at the long squeeze that was experienced in the FTX DeFi index on January 21st. As you can see here from last week's candle, it is a very wonky candle in the index, as we saw lows of as low as 4,200 points before closing the week at a high of 6,192 points. So this spike lower here means that the actual price of the index went as low as the low 4,000s level throughout the week before making its way back up. So let's take a look at the daily candles. And here we see that the index actually went down as low as down 23% for the day, in one day, essentially on January 21st. And this was in a 24-hour period. And notice here that this daily chart here had the highest level in trading that the index had seen historically. So that is interesting because it shows us a few things that happened during that day. Now, additionally, the perpetual swaps funding rates for both Aave and Ethereum, as we can see here, if we look at the 30-day average for Aave, which is right here, we see that it's at 0.06. And then if we look at the current rates for Aave, we see that it's at 0.01. So it's actually come down quite a lot. If we look at Ethereum on Binance, it's basically very, very similar. It has the perpetual swaps funding rates have dropped by more than half. So what this tells us is that these high levels, or these are signs that high levels of leverage have been washed out of these perpetual swap indexes because of the reset in the funding rates. Now, why does this happen? Typically, these market events happen when investors have borrowed way too much cash to purchase the assets that they are participating in get overexposed. Investors that are looking for a quick return typically purchase assets that, investors that are looking for a quick return typically like fast-moving assets. And additionally, they layer a lot of leverage on top of that, to get there even faster. So when investors borrow a lot of cash, it means that their very small price moves in the underlying assets will basically cause their portfolios to crumble and force them to sell their assets. Now, when sophisticated market participants see this, they can effectively start issuing large sell orders to drive the market lower, thereby causing forced liquidations in some of these portfolios, which themselves trigger even more liquidations in other portfolios. And then once the levels are low enough, the sophisticated market participants happily start taking the other side of those forced sales to start rebuilding their portfolio and then drive the market up higher once they have, repurchased all of their tokens at a much lower price. If we zoom out to the hourly chart in this graph, this lets us see some of that at play. So if we see here, let's go back to the 21st. Here's the actions on the 21st, right? So it started out the day in the mid fives, ended the day in the low fours. So here we see that there is a large order potentially to start selling. Then in this here, in the sort of mid fives, we see another set of large orders. But then very interestingly, we see that the largest order essentially starts coming in the mid four levels. So this could potentially be interpreted as sophisticated investors starting executing large sale orders on this around this range. They essentially saw the market coming down and pushed the market further down by executing larger sales at these levels. And then when the levels were essentially had broken the fives and in the mid fours, they started, we can see a lot of transactions in this candle here, which could mean that there was a lot of sophisticated investors rebuying back their token positions after selling them, call it in the mid fives and high fives. They were buying them again in the low to mid to 4,200. So that is essentially an example. Now, in these cases, when a long squeeze gets brought down, if there's enough new investors around, the long squeezes can get bought right back up, as happened in this case in DeFi. And we see that the index even continued grinding higher. This could potentially, this is a trend that could potentially repeat itself until essentially the new buyers run out and the tipping point gets reached where the trend starts turning. So now let's take a quick look at a long squeeze of epic proportions that is happening in the shares of GameStop. So last week and this week have provided us a unique opportunity to see one of the most dramatic short squeezes in modern history play out in the shares of video game retailer GameStop. So for those of you who are not too familiar with GameStop, GameStop is a physical video game retailer. It was actually a stock quite dear to my heart because in my previous career, I was actually looking at it for a while, and I even traded it as part of my job back in my previous career. I haven't traded it in many, many years. However, it's a stock that I happen, or a company that I happen to follow and know well. So it's quite funny when I saw this news come out, because I thought it would be very interesting to cover it. Now, as I mentioned, GameStop is a physical video game retailer with most of the stores located in malls around the US. So with malls taking a huge hit and sales going digital across 2020, the stock had been taking a beating throughout the year. Started out the year at 681. Let's just take a look at the chart here for GameStop and go out to the weekly chart so that we can see we can already see how dramatic this is. Wow, just look at the rise in the stock. But we see here that throughout the year 2020, it had started the year in around the 620 level, and it had gone to see levels as low as the high two, so 281 back in April. And it closed the year 2020 at $6. Now, the stock had amassed a short interest, as we can see in the article that I had in the past. It had amassed a short interest of 138% of the shares available for trading. And last week, the company announced that an activist investor by the name of Ryan Cohen, founder of a company called Chewy.com, would be joining its board of directors, which started causing shares in the company to spike as the first set of hedge funds and investors started covering their positions. So let's just zoom in here, because it's moved so much over the last little bit that it's hard to really appreciate. Let's go to the daily chart and see that first spike. So it seems to be that this is the first spike around December 22nd, when the activist investor gets announced. And in here, after that happened, essentially, investors started taking notice that people or other investors had amassed very large short positions that they now had to start covering in a crunch. Now, investors that caught notice to this started essentially piling onto the stock, because they anticipated that more shorts would have to run and cover, which were essentially buys that had to happen in the market. So these purchases, when an investor is short, they have to return the stocks that they borrow. So they have to repurchase them regardless of the price, or very likely the person who lent them the stock will have enough of a reason to liquidate any collateral that they have placed, if they feel like the person that borrowed the stock won't be able to buy it back. So once the Wall Street Bets subreddit group in particular, which is wildly popular, caught on to this, they started piling onto the stock. Like I mentioned, knowing that there would be a lot of shorts still needing to cover. So things reached a fever pitch last Friday when a large institutional short seller of GameStop by the name of Citron Research started calling the buyers of GameStop at these levels suckers. This, in essence, triggered a massive rally in the stock, which is here. You can see it. It closed the day at 51.08% higher, which is a very dramatic short squeeze. Today, we're seeing the stock up another 46%, having crossed the $100 mark. What's happening here is that basically a lot of investors understand that there is a disproportionate amount of short investors that have to buy GameStop stock, and they are essentially bidding it up so that these investors that have forced purchases will have to buy them from them at much higher prices. The stock, as of Friday, which has actually changed much more today, but as of Friday, the stock was up 245% for the year 2021. Now, while extreme, this example, this GameStop example, is a great reminder to investors that understanding the pain points that market dynamics create are very important, because investors that understand this can organize and go after other market participants. This is true in both examples, in the long squeeze and the short squeeze, and this is why it's always important to understand these market dynamics when you are an investor. Now, let's move on to a short summary. Now, as we can see from both of these examples, any type of investment decision or position that requires a borrow creates a market dynamic where the loan has to be repaid. Sophisticated market participants have ways of estimating the borrow levels in the market, and when the borrows become large enough, they present a very attractive opportunity that sophisticated investors will try to go after. This is why we follow perpetual swap funding rates so closely, as well as short interest in Bitcoin. The higher these indicators are, the more likely that market volatility will be present. Now, hope you found that useful, and we're going to be onwards to our difficulty commentary and our what's ahead for the week section. And now moving onwards to our Bitcoin mining difficulty commentary, we had a new difficulty adjustment kick in on Saturday noon, which brought us to a new difficulty all-time high of 20.83 terahashes, up 1.05% from the previous difficulty adjustment. Block times are back at an average of 10 minutes per block, and the mempool has come down quite a bit. While the mempool is still at December levels, transaction costs and speed should be much closer to normal this week, and the next difficulty adjustment is scheduled for 2 weeks from now and is already showing a slight increase to another all-time high in difficulty of 21.03 terahashes. It is likely that we will continue to see rising hash rate to catch up with the recent run-up in prices. As always, we'll keep you posted with any relevant mining information throughout our social media at HODL with Ledin. So as always, we leave you with our what's ahead for the week section. This week's a very important one, and it's full of important events. First off, the Fed. So the Federal Reserve, which has been the reassuring voice of investors since COVID started, is scheduled to have its first FOMC meeting of the year, and the first one under President Joe Biden. Now, this week, analysts are expecting the Fed to continue providing an encouraging backdrop to investors and businesses, and the Fed's policy decision to be delivered at 2 p.m. on Wednesday will very likely impact markets. So keep an eye on that time on Wednesday. Additionally, we have a GDP reading out of the US on Thursday. Analysts are expecting a 4% increase for the last 3 months of 2020. Now, while a 4% growth in GDP is very impressive, do keep in mind that the previous reading for Q3 was an increase of 33%. And now, while this new estimate of 4% is way lower than the Q3 reading, it does still mean that the economy is heading in the right direction, and it can be perceived as a good job, keep going nod to the Fed and its policy decisions. Now, elsewhere in the macro world, we're starting to see commodities picking up bids. Analysts at Goldman Sachs were quoted last week as saying that Biden's recent actions have been supportive to oil prices. And with the narrative for potential inflation around the U.S., more activity around Main Street vis-a-vis financial instruments, this type of part of the cycle typically has investors shift their views to potential industrial growth. With commodities having experienced prolonged suppressed demand and price action over a long period of time, investors may potentially start looking at the sector for growth opportunities. And something to keep an eye on in this first part of 2021 is the relationship between the FANG stocks and the commodities. So something that investors should be really paying attention to as a potential sector shift starts coming into play. Now, outside of the macro world, we have 13 out of the 30 Dow Industrial Company components reporting this week, which could lead to a week of very high volumes and decisive moves in the major equity indexes in the US. So something to keep an eye on as well. Throughout the week, we have a lot of heavyweights reporting on that front. And moving over to the Bitcoin front, we're seeing very interesting market dynamics at play. The compression of the GBTC premium to historical lows is likely the most impactful dynamic that is currently at play. The arbitrage of these types of market opportunities are signs that professional investors and institutional activity is coming into the market to make it more efficient. Now, while it makes competing for these opportunities more difficult, the trade-off is that it provides significant liquidity and legitimacy to these markets. Going into the Bitcoin options front, we are seeing a large open interest for the $52,000 strike for the January 29th expiry in the Deribit platform. And lastly, as we explained in our long versus short squeeze analysis above, these types of market dynamics are setups that lend themselves for a lot of volatility. And while we cover that the perpetual swap funding rates for some of these altcoins have seemed to gotten back in check after the last long squeeze of last week, signs abound that retail is still very much around and picking up steam. Now, as always, we will keep you posted of any other relevant information throughout the week through our social media accounts at HODL with Ledin and through the Bitcoin Economic Calendar. And as always, if you don't yet have a Ledin account, I invite you to check out ledin.io and learn how you can start earning 12.25% on your USDC and 6.25% on your Bitcoin. Thank you very much. I hope you enjoyed it. If you did, please like it and share it, and see you next week.